Good morning, everybody. Welcome to the Flow Show. Here we are with some fun and games going on in the end as we kick the week off, and a busy week it's going to be. Morning, Stel. How you doing, mate?
Hello, hello. Good morning. All good, all good. How are you?
Good stuff. Yeah, all good, mate. Nice long weekend over here. Burnt me bonds, as is customary.
Yeah.
So, yeah, how about you?
All good. Weather's a bit iffy here. It's hot, but it's raining and it's a bit cloudy and it's weird. But anyway, all good. I suppose in a few days' time it's going to be proper summer.
Yeah.
Yeah,
Well, sun's out here, so no sympathy from me, mate.
all good, my friend.
Good stuff. Good stuff. Right, well, let's crack into it. Get through what's been going on. Firstly, over in China, the F.A.C.E continues to fix the reference rate higher, fixed at 7.0818 today versus 7.0760 on Friday. So they're continuing to let that keep moving for now. We've had some fun and games, as mentioned, from the Bank of Japan. There were some comments out overnight from Finance Minister Suzuki saying that the Ministry of Finance's fiscal panel calls for maintaining yen credibility in guiding fiscal policy. Then Ueda was up in Parliament saying we haven't reached a sustainable 2% inflation yet. Inflation to slow down clearly in the second half of the fiscal year 2023. And inflation is likely to bounce back thereafter on wage growth and other factors, but there is uncertainty on that outlook. We'll continue monetary easing patiently towards goal. So that key word again, patiently, has replaced persistently. They also left their purchases for June, JGB purchase of June, unchanged. That might have been a bit of a headline because we did get this morning headlines that the BOJ, MOF and F.A.C.E, so all the government bodies, Bank of Japan, were holding an emergency meeting apparently this morning. Now they hold regular meetings usually monthly or as and when they want to call them, just to discuss various market matters. But it was reported that this was apparently an emergency meeting, which got the market a bit jumpy. We're up testing 141 in dollar yen, as you can see there, and we had a little move down to the low 140s. There was a bit of delay in when we got a press conference from the currency diplomat, as he likes to be called, Mr. Kanda, who's part of the Ministry of Finance now. And that was supposed to happen at 8:30 GMT, but it didn't come out till about 35 minutes after. So the market was a little bit jumpy on that. The comments were pretty much straightforward, nothing really boat rocking. They said they were closely monitoring the level of the yen, would act if necessary, so a mild bit of jaw boning there. However, Kanda was asked at the press conference by the press if this meeting was to particularly address or show that they were intending to verbally intervene in yen weakness, and he said that was not the case. Part of the reason was due to various risks that they see, one of which was the US debt ceiling stuff, which obviously now has been resolved. So as I say, the market got a little bit worried about what was going to come from that. Nothing came of it really, and we got a bounce back up to 145.60s, which is a bit of a level, and it's now holding again. But we've given up a lot of that move, and we've moved back down to the low 140s. I thought we might get a bit of a bigger jump, maybe up to test and even break the 141 if the comments came out as nothing much at all. But it looks like the market may have got a little bit nervous about just general chatter out of those guys. So we found a bit more balance in yen pairs at the moment. So the debt ceiling stuff has been resolved. That came out all over the late yesterday, over the weekend, and everything is going to be signed, sealed and delivered probably through the houses by next week. So barring any last minute flies in ointments. It looks like this is done and dusted, and we can largely forget about it until 2025 at least. Now, we are going to be probably looking at what's going to be happening now with regards to them building back up this savings account, the TGA, which is what they've been using to pay all their bills and debts and whatever since January, part of the emergency measures. A lot of the market are looking at how much issuance of bonds the Treasury are going to have to do to fill those coffers back up. The coffers sit at around 49 billion from around, sort of 500 billion that they comfortably like to have in the account. So we're probably going to be playing that game for a while, whether it causes any liquidity issues. Obviously, the more bonds they want to issue, the more money they have to raise, can present some issues. We're going to likely be trading those over the days ahead, seeing if there's any worries coming up from those. But by and large, I think we are now over the hump, the big hump, and we can, it will slowly fall out of the market's eye over the next few days. Of course, unless there's any problems in passing this stuff through the House next week. So there's still a little bit of tail risk, but we wait and see. We're at the end still. Do you reckon it's
surprise,
the end?
Surprise, mate.
Yeah.
Oh my God, seriously.
Who'd have thought it?
The question remains the Congress, and there's been already Congress members saying, there's no way we're going to be voting for this over my dead body, blah, blah, blah. Yeah, we know how that ends. Sorry to be so cynical, and to all our listeners, but, when you've seen something happen so many times, it's going to take something extraordinary to make it different this time. Now, the expression is different this time does work sometimes, but it's really on extraordinary occasions, and there are legitimate reasons behind them. And frankly, anybody who thought that this debt ceiling would not be passed, I think it's delusional. And because what's the alternative? There is no alternative. What do I think is going to happen? Well, yeah, there might be some screaming and shouting and and objecting, but this is going to get passed. They kicked the can for 2 years, which is the best case scenario, really, that we were hoping for in terms of markets. I've even seen pieces and comments on the internet and on various sites saying, well, what if we abolish the debt ceiling altogether? And I have to say that given the way things have been going over the past 50 years, why not get rid of it? I mean, why go through this every time and have markets being upset about it? And if you know what the end result is going to be, why not just get rid of it? But that's a different conversation altogether. But overall, it's going as we thought it would go, and they didn't leave it to last minute, not yet. And hopefully gets passed, which I think it will. And do you know what kind of majority it needs to be?
No, I don't, because each party owns a house, don't they? But so I think it will pass both houses, because if the leaders have agreed it, then obviously you're going to have a few dissenters, should I say, as you do in all political parties. But I think the leaders have sealed it up. But what about the market reaction? It seemed a bit muted. I mean, dollar yen took off a bit, but that might have just been, Japan stuff. But there's been a bit of a down move in yields, but it's nothing big, is it? This is one of those things where was the market already trading the deal being done, and that's why we've got a bit of a lack of reaction?
Well, I think that's the case. And if you'd asked 100 analysts, what do you think is going to happen with the debt ceiling? And there were banks who have these charts and or organograms, whatever you call them, with the probabilities in this. And I think remember Goldman Sachs saying 80% chance that it gets passed for 2 years. And if you asked 100 analysts before, I think the vast majority would have said, yeah, it gets passed in some form or another, which means that the market was probably already baked in. But there was obviously a little bit of worry, especially I think in really short-term yields. And We're seeing the 10-year US down by a couple of more, 2 or 3 or however many basis points, and the dollar absolutely flat or maybe marginally lower, and equities probably now are free to go to 4,300 in the S&P, which we've been saying all along. So the reaction, you're absolutely right, is muted because I think it was all pretty much priced in. Maybe, the markets are listening to these webinars. You never know.
Well, it's very suspicious that we talk about stuff on here and then it appears at certain banks in their research notes and other sources. So maybe they are. You never know. So are we ripe for a dollar sell-off now then, or is it going to? Do we need to just hold on till the US come in a couple of hours and see what they want to do with it?
Well, that's a good question. I think in the medium term, we're going a lot lower. The problem is that there's a lot of talk about how liquidity is going to be removed from the markets because they're going to be issuing more treasuries, which means that people are going to give up their dollars for these treasuries. So the issuance of more treasuries is good for the dollar because liquidity is removed. Well, in that case, how about they issue 10 quadrillion and then the dollar goes, Dixie goes to 500. I mean, I think that's, pardon my French, bollocks. In the very short term, maybe there is a little bit of a knee-jerk reaction, but it's like me having a credit card with a £10,000 ceiling limit, and then, I have a credit rating X, and then I say, oh, I can't afford the payments and all that. How about you make it 100 grand? And this is good for me. Of course it's not. So at the end of the day, this is not good for the dollar for one simple reason. I do not think that all this new issuance is going to be taken up by the market exclusively. I think that maybe not now, maybe not in 2 or 3 or 6 months, but I think the Fed's going to start monetizing debt again in a big way because there is no alternative. So when that happens, that means that money is being created. Money supply is being increased. So if in the very short term there is a little bit of a liquidity squeeze, in the medium term, I don't see any other direction than lower for the dollar.
Yeah. What about the QT side of things? Could they tinker around there rather than let stuff roll off and sell stuff? Could they keep reinvesting to help fill up the coffers, if you like?
They could do, and remember, the vast majority of the U.S. Treasuries are short dated, and they're coming to a maturity within the next 2-3 years. So they're gonna have to do something because if they're selling treasuries and they need, and more of their treasuries are maturing, somebody needs to buy them, and so they're going to be, will they be tinkering with the QT, with the duration of their debt? I don't know, but they have to do something. And yes, I'm bearish the dollar. I'm not saying it's going to be the end of the dollar or it's going to go to 50. No, but I think in the kind of medium term against the other majors, I think it's probably has not great potential. And before I get misunderstood, I'm equally bearish about pretty much all central banks, apart from only a few kind of bright stars out there, because they're all doing the same thing. That's the problem.
Yeah, that's the problem indeed.
Yeah.
Well, so I think we've got to see what the guys and girls in the US want to do with all this before we can make a judgment either way. But you can see from bonds there, yields are coming off, so that could be the confirmation move that we see pricing back out the risk from the debt ceiling stuff.
I think for the next few weeks, there's a high chance that the dollar goes higher first before it goes lower. So we have to be prepared for that.
Yeah, because we had the PCE and that was pretty sticky last week, and we got a big slate of data which we'll talk about shortly.
Yes.
Right, so we'll crack on through the rest of the headlines that are out over the weekend and this morning. More good news for the UK because the BRC shop price index hit another record high for May, up 9% year on year versus 8.8% prior. This is, food items, supermarket items and the like. There are reports in UK press over the weekend that PM Sunak might look to try and do a deal with supermarkets to cap basic food prices, things like bread and milk and whatever. So we'll have to see what comes of that. Over at the ECB, and ECB's McClough says my lead option is hikes in June and July and is open about subsequent decisions thereafter. Feels very relaxed about the market pricing of rates. Says upward momentum in core inflation slowed, but food price pressures are still building. Now, going back to the good old US of A, and last week, as I said, we got that PCE data coming in, and pretty much hot all round. Headline PCE up 4.4%, beating expectations 3.9, and the prior month. Core PCE up as well, a pip, was expected to come in unchanged at 4.6%. So sticky inflation over there still. Obviously coming down to the 4% levels is still pretty good, but it's still lower, higher prices, if you get my drift there. Prices are still rising, just not at a faster rate. Durable goods orders came in pretty solid as well, 1.1%. That number there was expected to fall 1%, so much better than expected there. Some of the components as well, there's the core measure of durable goods, which is the capital goods orders, non-defense ex air. That came in at 1.4%. So that strips out a lot of the big aircraft defense, that sort of stuff there. So that came in solid as well. So overall, not too bad on the data front. Michigan sentiment later on was a bit softer, bit of a move back from the 63.5 prior, but didn't fall as much as expected. Was expected 57.9, came in 59.2. Current conditions also dropping, but the inflation expectations had a bit of a pullback. Now this prior 4.6% was a big jump on the month before. I think it was 3.6 the month before, and then it jumped in April to 4.6. It's come back a bit to 4.2. However, the 5-year, the longer term inflation expectations rose through to 3.1%. Not as much as expected, but still a gain on that number there. So overall, the data in the US is still ticking along. There's no real big worries coming into that, but nothing also heating up over there either. Fed's Mester was out saying that this data, the PCE data, confirmed inflation is still too high. The PCE data underscored the slow progress on inflation, and says it is concerning. Tighter monetary policy is still feeding into the economy, and it says she may have to revise up her inflation forecasts for the Fed forecasts. That's i.e. her dots. Says everything is on the table for a June meeting and still supports Fed funds rate over 5%. So some fairly hawkish comments coming out from Mester there. And just looking through a few bits and pieces that we got from elsewhere. Chinese industrial profits taking a bit of a hit, coming down for June, although we're not even in June, down 18.2%. The other measure for April also big negative, but not as much as last time. Obviously, we had the bank holiday yesterday. There you can see that BRC shop prices in there. Unemployment rate in Japan coming in a bit low as well, 2.6%. So good news there. Bit of softness in the Aussie building approvals. Spain CPI preliminary numbers showing a decent dip to 3.2% from 4.1% prior on the CPI. The Eurozone measure HICP also coming down a good chunk to 2.9%. Was expected to rise in both those measures. So it seems economists and their guessings are all over the shop regarding what inflation's doing at the moment. Also, you can see that Spain retail sales pretty good year on year, coming in above expectations. PPI in Italy seeing some negative numbers on both fronts now, the year on year and the month on month numbers. So that's going to feed through into inflation further down the line. Not a bigger fall as expected, but still moving the way the ECB wants to see it. We got some business confidence numbers out as well, a bit softer in the Eurozone. Picking out the main points on this though: consumer inflation expectations, beating expectations, but still falling. This is one that's going to be looked at closely by the ECB because they like to look at price expectations. Also, companies' selling price expectations, either the likelihood they will achieve the pricing they want to set, coming in a bit softer as well than prior month, although higher than expected. So again, the inflation picture, particularly in the expectation front, is coming lower, and that's something the ECB will want to see for that. So as mentioned, we do have a busy week this week. It's NFP week, among other things. We kick off the data today with some house price data and US consumer confidence. So we get to see another look at the US consumer. Again, look at those inflation expectations for that one that come out there. A few more final GDP numbers and flash CPI numbers for the new month coming out of Europe tomorrow. We also get the JOLTS number from the US, which is going to kick off the jobs data that we're going to be looking at. Then we get on Thursday, we get some retail sales from Germany. We get the PMI, one of the PMIs from China. We also get another PMI tomorrow as well from China. So there's a couple there. They do have two over there. Final PMI numbers manufacturing for the Eurozone on Thursday. And that's going to be the main number there. Eurozone flash CPI coming in on Thursday as well. Then we get the ISM from the US. So that's going to be a big number to watch there. Keep an eye on the price measures and the jobs employment measures. And then Friday, it's the US NFP, and I'll have the non-farm payrolls competition up and running soon. Don't worry about that. It's not a double bubble with the Canada jobs, which can often come out the same day. So a nice clean one there if you're trading the loonie. But a big data week ahead. Anything you on your radar, Stel, particularly from that data this week?
Well, it's a big week, obviously. But you know, I have to agree with you. The numbers, the data we've seen from the US, and actually, just to answer your question, I mean, payrolls and average early earnings on Friday are going to be the big one. But everything counts now, and like you correctly said, the numbers have been, I don't want to say resilient, but they haven't been bad. So overall, things are kind of coming along, especially the employment side in the US. Inflation is dropping, but it's dropping at a slower pace than expected. And the same in the UK. You know, we're expecting a drop from 10%, whatever it was, to 8.1, and it came in at 8.7. So it is dropping, and as I've said and banged on about this forever and ever, you know, mathematically speaking, it has to drop unless things get really crazy with the supply chain and with the cost of things, of goods and services. But it is dropping, but it's not dropping as fast as central banks would hope. I still think we're going to see a terminal rate of inflation kind of I don't think we're going to get to 2%, but I think 3% is not unrealistic for the US. The UK is probably going to be a bit stickier, and we've said this before, because of energy prices affecting UK CPI a lot more than US. But I think then it's going to be very difficult for the governments and the central banks to bring it down at or below 2%. And that's why I think we're already hearing comments and whispers about the Fed changing the target and the ECB doing the same, etc., etc. So I think it will take a major crisis for inflation to drop to target and maybe below. But if that doesn't happen, I think it's going to be more elevated than normal inflation for longer. But I don't think it's going to be at these levels, not even close. I think we're going to settle somewhere quite a bit lower than here.
Yeah, no, I agree with that, mate. I agree with that entirely. So let's have a look at what's going on in markets. Well, we covered pretty much what's going on in yields. As just to repeat, keep an eye on these as the US lot come to town and see what they want to do. It might be that we start maybe pricing out some of the premium that's gone on in yields over the debt ceiling. Now we've got this confirmation. So I wouldn't be surprised if we saw yields maybe coming down a bit lower, but then as I say, we're going to switch probably fairly quickly. The debt stuff's going to end up in the rearview mirror, and we're going to be trading the data again and the central banks and whatnot. And on that basis, we might see yields just creeping a bit higher again. So dollar yen, just to put some levels on the numbers. Looking at the moment, just 140 is our main support area today, at least. Hasn't had a real test as of yet, so keep an eye on that. Top side, obviously into 141. We've now tried a couple of times. Wouldn't be surprised if there's some barriers talk up there as well. But that rally after the candle headlines couldn't get up above that 140.65. So decent enough numbers, levels in there to keep an eye on for the rest of the day. If we get back under 140, we may get a bit of a steeper pullback, but it's been a real grind, this one. It's not given back much at all so far. Euro dollar nearly nicked my stop. I've been long into this 107 level last week. My stop at 106.70, so that's come within a whisker of being knocked out, but we're back above the 107 level again. I think some of this might have been the moves in the yen pairs, yen crosses, euro yen, dragging down the majors in this, so it may not be a true reflection of price action here. Anyway, we're back above that 107, already trying to hold some support around that level, so it could be this was just a bit of a fake out. So keep an eye on that. If we do break under this 107 significantly though, then potentially we're going to be heading down to 105, and that's going to be a big old huge level. This one goes all the way back to 2003, so a massive level down at 105. Obviously there's plenty of traffic in the way before we get down there, but on the big picture basis, as you can see there, the 200-day moving average coming in there, and it's actually, I don't know why it's not on this chart. It should be. Let's see if it's on this chart. Nope. It is the 38.2 fib if you mark this September move up to there. So the 38.2 comes in at that 105 as well. So big number to keep an eye on there. Cables it's looking a bit better than the euro at the moment, doing that thing where it moves twice as much as the euro does. I think there's a little bit of central bank divergence going on in this one between here and the Eurozone, and you can tell that from euro sterling, because we have just broken down through the 86.40 area, which is one of my zones, traffic zones, if you like, that I've been watching for quite a while. So this might mean we're going to be on a fairly swift trip to the 86 big figure. Bigger support coming in 85, 70s, this area down here all the way down to 50s. So this break could be a bit significant. If we start to hold and find resistance coming in around 86, 45, 50, then the downside probably beckons. Need to get above 85, 70 in the first instance to relieve some of that pressure. But there's all the hard work to do back up the main 87s level up there. So not looking too good for euro sterling. I'm actually out of all my euro sterling longs on this move. I had a stop on the whole lot, including a bit from 86.20s that I've been holding for a while, 86.40. So I'm all out of that. Aussie dollar had another look at the big figure, but it's looking a bit more constructive. It's not making lower lows, it's actually making higher lows now, and we're just starting to make a few more highs. We've got been above the 85, 40, 50 area a couple of times. Can't get a hold above it just yet though, so it's not out of the woods on this one, but the downside looks a bit more supportive than it had in this move for the second half of May. So keep an eye on that one. Get back above that 65.50 and hold. We could be pushing on up towards the 66s. Dollar China managed to break into the 710s, and I locked a bit more off my long here. I haven't got much left on at the moment. I was looking to see if we got a dip down to this sort of zone here, 02s, 03s, but that's not to be at the moment. So it could be I'm getting out up here and then have to see what we do there. Still no stronger language than what we've already had from the PBOC or officials over there. So this one still has a green light to continue higher. As mentioned, if we get up to these higher levels, maybe the 720s, will start to get some stronger jaw boning. We've got the 61.8 fib, keeping an eye on. We've had a close enough test to it, but if we break above that, then we could be moving up to these sort of zones up here. Mike says, do you see euro dollar building a bottom around 107? As mentioned, it's, you know, look at the trend. The trend is pretty strong. We've broken the second leg, if you like, of this move since September. So that started when we had this move up in March. We've gone through all the fibs there, so I can probably take that fib out, actually, get rid of that. So can we find a bottom? Yeah, I think today is probably key for that. If we don't move back below 107, then, as I say, that move under is just a little bit of a blip, and maybe we can build and continue higher. But the jury's out at the moment. I want to see what happens during the US session, and then obviously we're going to get all the data coming through, so it could go anywhere on this one. But look for the signs. If it holds now and holds for a protracted period, then maybe we've got a bit of a bottom in play and up we go. If you want to try and catch the knife down here, you know where the levels are. We've got that low in today. That's one marker. But if you want to try again against the 107s, you know, don't give it too much room. When I look for bottoms, I want to look for confirmation moves. So Aussie dollar is a key one for that. As mentioned, you know, we made the low, then we couldn't get back to that low, then we made a higher low, and we're now seeing a decent period of time where we're not breaking down. And if we can't break down, there's only one way we can go. So you can take things day by day. Right now, I'm a bit more bullish Aussie dollar. See whether we move back higher, and that's even while I'm short. So I've still got a little bit more short on. And if we get back up a bit higher, then I'll get knocked out of that. But for now, it does look a bit more bullish in the Aussie dollar. Another one I've got in this morning or last night actually, was Euro knock, because we're up here knocking around the big resistance that we had.
Knocking around
in the knock.
Nice trade. I like that.
Yeah, I was umming and ahhing about this last week, and I was looking at maybe getting in around here when it was shown as resistance, but I held off because I didn't know what was going on, and over the weekend I didn't want to put anything on that close to the weekend. But we've tested it, and we're holding it for now. So technically, it's looking a decent level.
You know what? I'm selling some right now.
You're sick on in?
Yeah, I'm going to short some.
You probably get a better price than me, you pirate. I'm short 11.90.50 odd and change. So I'm playing this for two reasons. We've got the Norges Bank latest FX report or publication coming out tomorrow, and that will tell us whether they're going to be reducing their FX sales. That has been a big chunk of this weakness that we've seen, because they're switching into the new tax year, so they're going to rejig their figures and tell us what they need to do. There is maybe an outside chance that they pause sales altogether. I think that's a really low risk thing. So it's possible they reduce what they're going to have to sell. That doesn't mean this is going to reverse, because they'll just be selling less. But it takes out a bit of the strength behind why we've seen it so much.
I got 11.89.55. Damn it.
Oh, crap, Phil. Change your broker, mate. You know, because they were selling at one point, I think 1.6 billion, and then it's slowly come down. You know, if we get a number that's 500 million, that's less pressure on the currency. So it doesn't mean we're all going to suddenly reverse and end up back down at the tens. It just means that some of the selling pressure is weakening. You know, there's a big difference between buying 500 million and buying 1.5 billion. So that's why I'm short up here technically, and what's going on there. I also bit of a gut feel that maybe oil, and it doesn't seem to be going the right way. I thought oil might have a bit of a bounce on the risk on mood to do with the debt ceiling stuff. It looked to have been doing that initially, but it's given that up. So that's a counter influence to being short euro NOK. But again, I want to see what happens during the US session coming up. I know Stel and K-Man look at this. They've been looking at this euro NOK for a long while, so I hope I'm not stealing their thunder. But
no, if anything, you brought my attention to it, so thank you.
No worries, mate. Just don't blame me if it goes wrong. I'm keeping my stop fairly tight, 95.75, because if this level does break, it's probably going to fly. So I don't want to risk too much. So it has got a fairly decent risk reward ratio on it. We were talking about risk reward ratios last week. If we get a move initially under 11.85, I'm probably going to take a bit off if I see that sort of move, and then take a bit more off down towards this 67.70 area. If I see us down here, I'll then bring that stop probably under entry and just start trading it below and see what it wants to do after that. I've got no real targets in mind. This is a get on. If it goes my way, see how far I can push it and take it from there. But it's going to need a bit of help maybe from the Norges and from oil, but we'll see what happens with that one. Technically, as I say, oil's dipping back and we're still not breaking that high in euro NOK, so it gives me a bit of conviction for that one. Let's have a look what's going on. Ali's in. Morning, Ali. You are long dollar CAD at 135.73. Let's have a look at that one quickly. Okie doke. So, yeah, a bit of support around this 135.50s. You got your stop there. I don't know. Your stop's pretty much right on a line I've got. So you might want to consider that one, maybe moving it away, maybe just under, or you do what you want with your trade. It's not for me to tell you, but I've got a level 135.50. We could have a bit of ping pong between there, 136.50, which is the main resistance level. As you can see, last week that held up there again. On the downside, you're really looking at 135s. And this zone here down to 134.65.70 area. You're not. It's looking lower even while oil is coming lower. So usually you'd see this moving up as oil's coming down. So obviously there's a strong correlation. But when you see that intraday, at least that dollar CAD's coming down even while oil is falling, you've got to think that the influence is probably on the dollar side of things rather than the oil side of things. So just for today, at least, that correlation looks a little bit broken between dollar CAD and oil. But as we know, that can change in a heartbeat. And you're keeping the position small anyway, very sensible. There's lots of stuff happening today. Still, you got any pairs you're looking at in particular today? And wants to look at Guppy, which I can do so in a second. Still, you got anything?
Nothing that probes my interest at the moment. Not really. I'm looking at metals as always. They were under a lot of pressure this morning, seem to be bouncing back. It all depends on the dollar, really, and if it manages to squeeze higher before it goes a lot lower. But no, I don't have anything that I'm looking at. I mean, obviously, the one that I've been talking about for a while is the S&P, and I do think now we have broken out to the upside, and 4,300 is coming. What happens then? It will depend on a lot of things. But for now, I think definitely not worth being short, and I've said this for weeks now, and I hope that people have been paying attention. But no, I don't have anything else to show. Sorry, maybe tomorrow or maybe after Jolts. We'll see.
Yeah, no worries, mate. I just thought if you had anything in particular, no problem at all. I'll come back to Guppy in a moment, Anne. But Stel's quite right. We've had this move up above 42 now, and this prior area as well. It just seems to be holding around here now. So that looks to be our initial support area. Just give it a take. Give or take a few shekels, 42.10, 12, that sort of area. So that's our market. It's given it a bit of a springboard higher. So this is one market that's keeping its gains even after the US debt stuff. As Dale's been mentioning, you know, if we're going to hold up here, we could well get a move back up towards 143. It's definitely looking that way at the moment. But I know I might be repeating myself, but trading is all about price discovery, working out what the market wants to do. So until I get a few hours into the rest of today to see what everyone else wants to do with it, because obviously Asia's reacted, obviously UK, Europe's reacted to the US debt stuff. We've not really seen the US reacting to it. And so that's going to be a big clue as to what we do from here on out. If stocks rally, S&P rallies, on the back of it, we could be at 43 pretty quickly. If it doesn't, and if it comes back under 42, that will tell its own story. And then maybe we're going back in the box at least for a long time. Guppy, Anne's looking at Guppy. Well, as you just saw on the chart there, banging up above onto some decent resistance, a trend line that is a third toucher. So, you know, take it for what it is. But we had that move up above the break above the prior highs around the 172s, 15s, 20s, whatever you want to call it. We've moved up to this trend line. It's holding here for now, and it's going a little bit against what's happening in the other yen pairs. So this one looks a bit out on its own at the moment because it's keeping the gains, whereas something like dollar yen is pulling back a bit. So a bit of a divergence there in that cross. The pound is looking strong. As I said, I think we're over the debt rubbish. This one's trading the central bank divergence again. So a little bit of relief there. But that's, again, dollar's weakening a bit as we speak. Dollar yen now 140.17, so it's coming down a bit. What are you doing in this one, Anne? Are you short? You long? Let us know where you're at. If you're trying to short it up here, you've got a good level. But if we get a break, then you're looking at a long. So you want a dip. Well, that's looking pretty solid around this 173s. Call it down to 172, 60s, 65 perhaps down there. Bit of a break point as well. So it's well defined where you want to try and get in at least. 175, 176. Okie doke. That's a bit of a, I did have a level just up above, probably a longer term one. So yeah, 175.40s, which was a prior resistance point. We broke it. We found it as support. This is way back. This is going way back 2014-15, but a pretty significant area that's seen a bit of action over a long period of time. So that's why that one's been sitting on my chart for probably forever. Not that I look at this one a lot. So that's going to be, if we get over this hump, that's where you're going to need to watch out for. You need to get above that 175.40s area to see your 175.76s up towards these highs here. Obviously, Bank of England, a big, how should I call it? Big increase in rate expectations for that. You know, the market now pricing a high rate of 5.5%. And we've had Bailey coming out and saying he hopes that there's no more hikes to come. So really getting the screw turned on them at the moment. 5.5 may be towards the real high end of expectations and where the BUE might take it to. It's still going at 5% in my opinion, but any higher we shall have to wait and see. Anyone else for anything else? I hope that's helped you out a bit, Anne. You didn't catch cable taking off this morning. I don't think many did, Mike. Dollar was looking pretty healthy this morning. It has flipped around. Yeah, ECB and the BOE are hawkish. The Fed's hawkish. The RBA's been hawkish. Lots of banks are hawkish, but as we've noted, the currencies aren't responding because a lot of the stuff is against the dollar. And as we've come through this debt stuff and everything to do with that, we're now going to go back to trading the fundamentals. So that's going to be our influence this week. What about the fundamentals, says Ali? Who at this point will win? Fed, BOE, BOJ, who will win? if I had to put names down, and Stel can jump in here as well. I think if you're looking at the fundamentals, all of them are showing resilience. Okay, we've been saying it for a few weeks now. No one is collapsing, but no one is showing any real sort of positive strength, bubbly type economics or economies. I think the Fed, I think the US will likely be the top of the bunch in terms of economic activity, purely because of its size. The Eurozone should keep trucking along as well. The UK, everyone was writing off the UK months ago, and now they've changed their tune as well. Even Japan is still showing economic resilience. So if you have to score them, the US is going to come out on top, then probably the Eurozone, and then you're putting all the rest in the pile, BOE or the UK, Japan, other countries as well. China obviously is in the mix. That could be the surprise weakness amongst them all. But I'm not expecting there to be big differentials between them. I don't think the US is going to start growing at 6% while the Eurozone is going to be growing at 0.1% or anything like that. I think they're all going to be pretty much the same, but we're going to be trading who's a little bit better than everyone else. Don't know if you've got a different opinion to that, Stel.
No, I agree in broad terms. Which economy do I think has the best potential? It's tough one to call. I've said before. I think the UK is going to be the surprise performer of the year, but yeah, it's difficult. It's difficult to say. But I agree in the fact that the US, the Eurozone, the UK, they're not in any severe distress. Let's put it that way. They're trundling along, and we're seeing economic indicators, loads turning, of course, but still not flashing red lights, warning lights. I think once more the problem is going to come from housing. It almost always does, and what I'm really worried about is commercial real estate. And if you look at data from the US, there's lots of unoccupied commercial real estate, and if you add that with the fact that mortgage rates have gone through the roof, I mean, I think housing is might be in all sorts of trouble, probably starting from the US, and when that happens, the whole world kind of follows. So another reason why I'm a little bit nervous about the US and the dollar in the medium term. So just my 2 cents.
On that, just quickly, I'm reading a couple of stories about the you don't take the zero hedge view of things, but there's this thing where it's like a collective investment where people have been buying apartment blocks or companies have been buying apartment blocks and then selling it to investors. So it's almost like the timeshare. Remember the old Spanish timeshare type thing?
Yeah.
They've been doing that, and people have been getting shares of apartment blocks, ramping up the rates, and obviously people are cost of living and everything are putting a pressure on, and now there's a potential looming black hole with all these people who have invested tons of money in apartment blocks that aren't worth the money they're written on, or people are not being able to pay their rent, so they're not getting the income from it. And this is being flagged as one of the potential risks to the property sector in the US. I don't know how much of it's true, but something to keep an eye on in that one.
Yep.
Anyway, that's we'll call that a day for today, just to stretch our legs to start the week. Plenty going on, plenty to trade for the rest of the week. So as always, we wish you a good week ahead. Thank you very much for Stelios for coming to the Flow Show and keeping me company while Kay's enjoying the sunny weather in Belgium for another week. Have a great week.
Thank you, Ryan, for being here and doing this awesome show every day.
Thank you very much, mate. Thank you very much. Keep an eye out for the non-farm payrolls competition, which I'll try and get done today, if not first thing tomorrow. And you can have a crack at that and win a prize on the ForexAnalytix platform. See you all tomorrow. Have a great day's trading. Take care.
Ali, you murdered my name. Come on. It's not Stillonis. Anyway, thank you. Thank you, everybody. Thanks. Thanks.
See ya.